Welcome back. Today we take the most comfortable belief in all of trading, that price moves because of the news. We test it against real data and keep only what survives. This one is a favorite of mine. Come argue with me. Here's the sentence you have read 1,000 times. The price dropped because of the news. Clean, obvious, everybody nods. So let me put it on trial. Because here's the same kind of news, a different day, and the price went up. Same type of news, opposite move. If the news caused the drop, what caused the rise? By the end of this, you will stop asking what was the reason and start asking a much better question. Let me show you why the tidy story is mostly a story. In about 10 minutes, you will know what actually moves a price, why at short horizons, much of the next minute is closer to noisy order flow than to a clean, named cause, and why the confident explanation on your screen tonight was very often written after the move to fit it. Let me steelman the myth, because it is half right and it deserves the credit. News genuinely does move markets. A real surprise, a number nobody saw coming, an event out of nowhere, that moves price hard and fast. And the story writes itself, honestly. When something truly unexpected hits, the headline and the move really are the same event. That part is true, and you should keep it. The trap is the leap from news sometimes moves price to there is always a clear reason, and the reason on screen is it. Watch how easily the reason gets manufactured. Every single move, up or down, big or tiny, gets a caption by the end of the day. The market never closes without an explanation. Does that strike you as a market that is genuinely understood, or a newsroom that simply cannot leave a blank where a reason should be?
Okay, but back up. Forget the headline for a second. Mechanically, what even makes the number on my screen change at all?
Good. That is the right place to start, because the answer is almost boringly simple, and the whole lesson hangs on it. A price is just the most recent handshake between one buyer and one seller. We built that in lesson 1. So the price moves for exactly one reason. The balance of who is willing to buy versus who is willing to sell right now shifted. Mechanically, every price move shows up as a shift in that balance. That feels too simple, so the harder question is what shifted the balance? It shifts for 4 kinds of reasons, and only one of them is the one people talk about. 1. Information. Somebody learned something and changed their mind. 2. Mood. The same facts, but the room got greedier or more scared. 3. Forced flow. Somebody had to sell. A fund meeting a redemption, a leveraged trader getting liquidated, a treasury rebalancing on a schedule. None of it an opinion about value at all. And 4. The big one nobody puts in a headline. Noise. A constant, restless churn of small orders, arriving in no particular order for no particular reason, that keeps the resting point wiggling every second of every day. At very short horizons, a lot of what you see is this: noisy order arrival, liquidity, and timing. Not information, not even mood. Not every wiggle deserves a story. You saw this at the very top. Commit to an answer before I explain it. Same headline, 2 opposite moves. Of the 4 things I just showed you, which one decided whether the candle was green or red that day? Say it out loud.
My gut says the news, but if the same kind of news can go both ways, then the news alone cannot be enough to decide the direction. So it was something else. I just do not know which.
Exactly the honest place to be stuck. Here's the missing piece, and it is the whole lesson. The driver is not the news. It is the surprise relative to what was already expected. The crowd does not react to the fact in isolation. It reacts to the gap between the fact and what it had already expected.
So a price can have already used up, quote unquote, the news before it even comes out.
That is exactly it, and it is why 2 identical headlines move price in opposite directions. The first time, the news was worse than the crowd expected. The result landed below the line. The beam tips down. Red candle. The second time, the very same news was better than the crowd had braced for. It landed above the line. Green candle. Same fact, opposite gap. The headline never told you where the line was, so it could never have told you which way price would move. Here it is in the real world, a large cap stock. The company reports genuinely strong results. The headline says, great earnings, and the stock falls. Not because the news was bad, it was good. It fell because the crowd had already priced in even better. and nearly great came in under the bar they had set. People call this sell the news, but the cleaner explanation is that the move came from the gap. The good news was the story. The disappointment versus expectations was the move. So when you read stock falls on great earnings and it sounds like a contradiction, it only sounds like one if you think price tracks news. Once you see that price responds to surprise, not the headline alone, it is the most natural thing in the world. Now the uncomfortable part, and it is the part almost no channel will tell you. Even the surprise story is too generous. On most days, there is no surprise to point at, and the price still moves, sometimes a lot. Here is Ethereum on a quiet day in our own daily data, with no obvious scheduled catalyst and no clean headline that explains the move. It still moved about 3%. Motion with no clean story attached.
Okay, but come on. Surely there was some reason. Dig hard enough and you can always find something.
That instinct right there is the thing to put on trial. There is always something if you dig is unfalsifiable. You can always find an article from that day. The question is whether the article caused the move or just happened to exist near it. And the research on this is brutal. A famous study by Cutler, Poterba, and Summers looked at large stock market moves and asked whether each could be connected to identifiable public news, big enough to explain it. For many of them, it could not. The move was visible. A clean public cause often was not. And one spring afternoon, the entire United States stock market acted this whole argument out in public, start to finish, in a single day. So let me just tell you the story. May 6, 2010. An ordinary Thursday in New York. The mood was a little tense. Grease was melting down in the background of every screen, but nothing anyone would have circled on a calendar. Just a normal, slightly nervous afternoon, right up until about 2:32. Then the floor gives way. In roughly 10 minutes, U.S. stocks fall off a cliff. The Dow drops hundreds of points, about 9% down at the worst moment of the day, and something like $1 trillion of market value simply evaporates.
$1 trillion? Gone in minutes? What had actually happened?
At that moment, nobody knew. Hold on to that, because it is the entire point of the story. For a few minutes, prices stopped making sense at all. The buyers had simply stepped back, the liquidity had drained out of the market, and shares of household name companies print trades at a penny, while another prints at $100,000 a share. People who were on trading desks that day described just standing there, staring, because the numbers on the screen had stopped meaning anything. And then, within about half an hour, most of it came back. The market closed down only about 3%. A bad day, not a catastrophe. The whole round trip, cliff and recovery, took less time than a lunch break. But that evening, every outlet had a confident explanation anyway. A trader with a fat finger typed billions instead of millions. It was grease. It was the machines. Tidy, confident, mutually contradictory stories, all published within hours of the close. The regulators, the people who could actually see the order flow, took about 5 months to publish their answer, and it looked like none of the evening stories. A single large automated sell order had met a market where liquidity had quietly evaporated, and algorithms ended up passing the same contracts back and forth like a hot potato while the human buyers stepped away. So hold the timeline in your head. The move took minutes. The confident stories took hours. The real explanation took about 5 months, and parts of it are argued about to this day. The move came first. The story came later. And your evening market recap runs the same ritual every single day. It is just usually too small to notice. And it lines up with something Bear New hammers in the very first chapter of algorithmic short selling, the random walk reality. Over short horizons, the direction of the next move is often close to 50-50, even for serious professionals. That does not mean skill never exists. It means that much of the short-run motion is noise, and noise has no direction to predict. There is a line that holds all of this together, and it has been passed around trading floors for the better part of a century. Benjamin Graham's dictum. In the short run, the market is a voting machine, but in the long run, the market is a weighing machine. And to be honest about the sourcing, it is Warren Buffett who made the line famous, crediting his teacher. In the short run, votes. Mood, forced flow, noise, whoever happened to show up today. In the long run, weight. What the thing actually earns and is. Every confident evening explanation is a report about the voting. The weighing takes years, and it never reads the evening news. And when an analyst confidently calls the exact level, Bear News' third chapter has the receipt for that too. Point forecast accuracy, the precise, "it will be exactly here" call, is genuinely poor. A tiny fraction of one-year price targets land anywhere near spot on. The confidence is real. The accuracy is not. Which brings us back to your screen tonight. Your turn, right now. Here is a real-sounding market explanation, the kind that runs every single day. Pause the video and find the hole in it before I say a word. What is wrong with this as a cause? Here is the flaw. Read it again and notice. It would have fit a green day just as well. You would just swap slips for climbs and keep every other word. Weighing the rate path is true every day. Lingering uncertainty is true every day. There is no number, no magnitude, nothing that could have been wrong. A sentence that fits every possible outcome explains none of them. That is not a cause. That is a horoscope with a ticker symbol. It was written to fit the move after it already happened, by someone whose job is to never leave the box empty. The move came first. The reason was reverse engineered. Let us do the honest case file, where the simple story works, where it breaks, and why. Worked first. When a genuine, large, unexpected event hits, the news story holds up fine. The surprise was real and big. The move matched it. The caption was earned. On those days, "the price moved on the news" is a true sentence. Keep using it there. Then it breaks in two places, and we just saw both. It breaks when the news is real, but the surprise points the other way. Our great earnings stock that fell. The move tracked the gap versus expectations, not the headline, so the story had the sign backwards. And it breaks completely on a quiet day like that Ethereum 3%, where there is no news to pin it on and the motion is mostly noise. The story does not just get the sign wrong there. There is no story to get right. And the why ties them together, because it is one mechanism the whole way through. Price moves when the buyer-seller balance shifts. Sometimes a real surprise shifts it. That is the worked case. Sometimes expectations had already moved the balance before the news landed. That is the great earnings break. And most of the time, it is just the random churn of orders. That is the quiet day break. The tidy headline only ever describes the first one, then gets borrowed to explain the other two. Which is exactly why this whole series shows you a distribution of what historically happened next. Never a single confident reason for what just happened. A reason hides the randomness. The distribution shows you how much of it there is. Lock it in. Not what was the reason today, the deeper one. In one sentence, what actually moves a price?
Mechanically, it is the balance of willing buyers against willing sellers tipping one way. But the headline by itself never tells me what tipped it.
Exactly. Sometimes the shift comes from a real surprise versus expectations. Sometimes from forced flow or mood. And a lot of the time, especially at short horizons, it is noise wearing a story afterward. You now flinch at a sentence most people read every day without blinking. One question for you, and it is a real test of whether today landed. Here is the test I want you to keep, and we will come back to it all series. Call it the story test. Find one market headline that says price moved because of X. Then ask, would this exact sentence still work if the price had moved the other way? If it would, it is probably not a cause. It is a story. The harder follow-up on why great earnings and a falling price are not a contradiction is in the pinned comment for anyone who wants to go deeper. And because half of you watch this with a notebook open, here is a second one, a classification drill. I will describe 5 moves. For each one, name the most likely driver from today's 4. Information, mood, forced flow, or noise. 1. A coin jumps 8% within a minute of an unscheduled exchange announcement. 2. An index drifts down 0.5% on a day with no news at all on thin volume. 3. A stock drops hard in the exact minutes a large fund's well-known month-end rebalance executes. 4. Nothing new is published for 2 days, but everything falls together, and each day's fall feeds the next. 5. A token climbs 3% over a quiet weekend and gives all of it back by Monday morning. 5 answers, 1 word each, plus a line of reasoning. Post them below. We read the comments, pin the sharpest answers, and walk through the full model answer in the pin thread. And to be clear what that is, we show you how to reason, how to tell a real surprise from a story stitched on afterward, never what to do with a position. We hand you the method. The decision is always yours. Strip it back. Prices do not move on the headline alone. They move when the balance between buyers and sellers shifts. And the headline only matters when it carries a genuine surprise against what the crowd had already bet. The rest, most of it, is noise wearing a costume, dressed up after the fact by people who are not allowed to leave the reason blank. That is not a flaw in the market. It is the texture of it. And the sooner you stop demanding a clean story, the harder you are to fool. Next time, we untangle 3 things people constantly confuse: investing, trading, and gambling, using the exact same buy click. If you take one thing from today, take the story test. Run it on the next headline that claims to explain a price, and watch how often the story only fits in hindsight. That quiet habit is what puts you a step ahead of the crowd. Subscribe, and I will see you next time.